Australia's Q2 CPI figure released today sat level with expectation at a rise of 3% on year, 0.5% on quarter. I have Evan Lucas of IG Markets on the line now. Evan, does today's figure continue to contribute to the notion that Aus inflation is finally the beast tamed?
Good question, and probably at this stage there are certainly a lot out there that would suggest it could be. But again, having a listen to what we've heard out of the RBA, particularly over the last 6 months, is that at the moment they are still suggesting that core inflation, so the trim mean inflation, which did come in ahead of expectations at 2.9%, is still well and truly inside their current bracket, which is 2 to 3%. And they do point to the fact that there is still some softish domestic data, and that they believe at the moment that the cash rate is also at a level that they are happy with and believe is sustainable. So in terms of taming it, it certainly is a possibility. They had certainly always watched inflation very closely, but just listening to what they're saying in terms of the other parts of the economy that are still struggling, which is wage growth, which is also employment, which has started to tick up, any form of confidence hit to those would probably be a negative for this economy, which is still seeing sluggishness in the non-mining. So yes, inflation is getting to the top end of the band, but if you have a look over the last year on a quarter-to-quarter basis, it is actually slowing down, and it therefore looks like coming in at around about an implied figure on quarter-on-quarter basis of 0.65 of 1%, which is just above their expectations. So yes, it's high. Yes, it does show that things are still growing, but in terms of the overall figure, it's still in their band, and they believe that that is actually where it will hold over the next 6 to 12 months particularly, and therefore they currently believe policy will remain as is.
Evan, you've touched on this already, but which direction could this prompt the RBA to now move? Could interest rate increases soon be back on the agenda, or is the central bank likely to take a wait-and-see stance?
I think one thing that has certainly come out of today's figures that is the most likely outcome is that we now will probably move away from some that had alluded to the idea that we could actually get a rate cut. We did see on July 4th that Glenn Stevens himself actually had a fairly aggressively dovish tone in his speech when he was suggesting the RBA was ready to act, that the high Aussie dollar and the fact that it remains at a historical level, that they could act to actually alleviate this area, that they were also ready to act on the fact that the non-mining space was also not firing. All of that data now suggests that's probably slightly out of his reach, in the fact that if you did actually drop interest rates further, you would therefore have a runaway issue with inflation. So that looks like it's off the case. The question therefore becomes whether or not you get a rate hike. And again, I allude back to what we talked about before, where wages, employment, and also the fact that you still have sluggishness parts of the economy would therefore probably tie his hands. Yes, we have a housing issue here where some people suggest we are in a bubble and inflation pushing to the high end, but he's sitting in a band that is probably either, you can look at it from 2 points of view, it's either a little bit uncomfortable and he's having to bear it, or the other way of looking at it is that he's in a happy medium where he doesn't have to move, because at the moment both the push and pull factors for a rate hike and a rate cut are probably holding him right in the middle.
Let's consider then market response for a moment. Aussie dollar moved higher following today's CPI release, yet showed next to no reaction to RBA Governor Glenn Stevens' speech on Tuesday. Walk us through market thinking here.
Yeah, Tuesday's speech was quite interesting, and you've got to remember where he was addressing. He was addressing the Annika Foundation, and that is actually for depression. So there was probably a reason why he didn't talk about monetary policy at all. It was probably not the speech to do it. And again, alluding back to the speech before, which was the July 3rd one, where there was a dramatic move in the Aussie dollar, it dropped around about half of 1 cent on what we saw from his speech. That's probably a better comparison. The today figure really, therefore, as I said before, rules out the possibility of a rate cut in the next 3 to 4 months. Now, again, that comes down to whether or not we see inflation dropping away and things in this country also starting to show that it's still suffering, or whether or not it does hold true. If it holds true, there's no doubt that it is probably very, very unlikely that a rate cut could happen, and that's why the Aussie dollar pops. And at the moment, you've got to remember that there's two sides to every equation, and the Aussie dollar US dollar pair is still being driven very much by the US side. It is very, very easy on a yield basis for US investors particularly to come to this country. At the moment, you come in and buy an Australian AAA government bond for 10 years at between 3.7 and 3.84%. So that is a very tidy family income, and currently the currency differentials are still very, very positive. So all of that is also driving. So if you want to get into this country with regards to those kind of yields, any data that can give you a chance to actually buy up the Aussie dollar, you're going to do it, and that's what we saw today.
Evan Lucas of IG Markets on the line there, who also told Dukascopy TV that the next item for RBA watchers to look out for will be the private quarterly expenditure numbers. For more insider tips and exclusive interviews, do stay tuned to Dukascopy TV. But for now, it's goodbye.